Hi everyone, Nick here. Welcome back to my channel. Inflation has been heating up and people are starting to worry. I want to provide you the most value, so we won't be speculating on if inflation will go up. Nobody knows. Instead, we are going to discuss how inflation is calculated and the risk it poses to different types of investors. For investors that want inflation protection, I'm going to summarize a research paper from Vanguard that outlines why inflation-protected securities are probably the best option. Inflation-protected securities are bonds sold by the US government with interest payments tied to inflation. There are two types: Treasury inflation-protected securities, or TIPS for short. The other are I-bonds, which are similar to the savings bonds your grandmother probably bought you. I'm going to walk you through the details of TIPS versus I-bonds and how to buy them. Before we get started, producing a video packed with value like this one takes over 10 hours of my time. I provide this value for free. All I ask in return is that you smash the like button if you get value. This helps YouTube share this free financial education with more people. If you want to learn more about investing and how to achieve financial independence, make sure to subscribe. Inflation is simply the increase in the cost of goods and services. The US government measures inflation using CPIU, which stands for the Consumer Price Index for urban consumers. This includes major categories of expenses like food, energy, shelter, electricity, and so on. Here is a graph of the CPI since 1913. The red line shows the yearly inflation. In the past 10 to 20 years, we've had mostly slowing inflation. During the 1970s, inflation shot over 10% per year. At that rate, the prices of goods would double in about 7 years. Many investors are starting to worry that this may happen again. Everyone basically expects inflation to be around 2%. Markets do well with this level of inflation. The main problem is with unexpected inflation. This white paper from Vanguard, linked below, shows asset class correlations to expected versus unexpected inflation. A higher correlation to unexpected inflation means the asset class provides better protection. We can see short-term TIPS and commodities are best according to this paper. And this makes sense. The price of commodities would rise with inflation, as would the interest payments for inflation-protected securities. Stocks, gold, and real estate are typically considered to be good inflation hedges. The paper shows that historically, these asset classes have provided some protection against inflation, but it was not consistent. They may do well in some periods of unexpected inflation, but not in others. For the long-term investor with a risk tolerance, you will probably get enough protection from inflation with stocks and real estate. These assets typically have some of the best returns. You can probably weather the storm if we get some unexpected inflation. In my opinion, the investor that will be most concerned about unexpected inflation is someone whose portfolio is mostly in lower risk bonds. Bonds struggle with unexpected inflation. If you are a retiree living on bond coupons, it could be devastating to have the price of goods go up by more than 10% per year. You could lose a good amount of purchasing power. In my opinion, it would be reasonable for retirees to seek some inflation protection against their near-term expenses. I don't think it's necessary if you have a reasonable amount of stocks or just willing to tighten the belt a little. However, if you want to smooth out some of the risk, I think it could be a good idea. The paper identified commodities and short-term TIPS as the best for protection against inflation. The paper shows commodities provided a higher degree of protection, meaning in inflation, they went up by more than the short-term tips. However, inflation protection doesn't come without a cost. It will likely lead to lower returns during normal times. Over the long term, both of these asset classes have had returns closer to cash. For commodities in particular, improving technology and efficiency acts as a deflationary pressure against their price. Short-term tips will have a low fixed interest rate and be similar to cash, but the inflation adjustment will provide some protection. Commodities are generally a lot more volatile, which makes them a bit less attractive in a portfolio that is meant to provide stable income, like the portfolio of our retiree. This is why I think short-term tips are best if you are an investor seeking an inflation protection. You could also use tips, commodities, and possibly other asset classes, but it might be a bit overkill. The Vanguard target date funds allocate 17% of the portfolio to short-term tips for investors in retirement. I think this is a reasonable approach. Target retirement funds are by far the simplest way to invest. You may give up some minor optimizations, but they are great if you want to be completely hands-off. I made another video on target retirement funds, which I'll link up here and below. Now let's discuss the details of TIPS, I-bonds, and how to buy them. Both are indexed to CPIU, the Consumer Price Index for urban consumers. You might have noticed the inherent conflict of interest here. With these securities, you loan the US government money, and they control the calculation of how much interest they have to pay you. I'm not saying there's any foul play, I'm just pointing out the possible conflict of interest. Both TIPS and I-bonds have a fixed interest rate. This is like a normal bond where there's a fixed rate when you buy the bond. With I-bonds, there is also an inflation rate that changes every 6 months. It gets added to the fixed rate, resulting in what's known as the composite rate. This is one of the major differences in TIPS and I-bonds. With TIPS, they adjust your principal for inflation. This means they pay you the same rate of interest, but on an adjusted principal. Whereas with I-bonds, they adjust the composite interest rate. Another difference is that with TIPS, you receive a payment every 6 months. With I-bonds, the interest rate accrues in the bond. You don't actually receive it until you redeem the bond. Both bonds are exempt from state and local taxes. For TIPS, the federal tax is owed on both the interest payment and the principal adjustment. Yes, even though you aren't paid the principal adjustment until the bond matures, you have to pay taxes on it in the year of the adjustment. For I-bonds, you can defer the tax until the year you redeem the bond. You could also elect to pay the taxes on the interest each year with the I-bonds. And remember, taxes on interest rates from bonds are treated like ordinary income. They're not taxed like long-term capital gains or dividends. The duration of TIPS bonds are 5, 10, or 30 years. Since TIP bonds are sold on the secondary market, you could probably buy a TIPS bond that matures in 6 months, or really any time, from someone that owns one. I-bonds don't have a fixed duration. They allow you to earn interest for up to 30 years. As mentioned, TIPS are traded on the secondary market. You can sell them to someone early if you choose. For I-bonds, you have to wait at least 12 months to redeem them, but you'll have to pay a penalty of 3 months interest if you redeem them before 5 years. After 5 years, there is no penalty. You can buy both of these through Treasury Direct, the US Treasury's website. For TIPS, you could also buy them through a broker on the secondary market. For I bonds, you also have the option to purchase them with your tax refund. There is a $100 minimum for tips and a $25 minimum for I bonds. For all intents and purposes, there's probably no limit on the number of tips you can buy. At a single treasury auction, there will be a limit which is in the millions of dollars. Probably doesn't apply to most people. Beyond that, it's just a limit of how much is out there on the market. For I bonds, the treasury limits you to $10,000 per SSN per year, and an additional $5,000 per SSN per year if you're purchasing them through your tax refund. Both of these bonds offer limited downside in a deflationary scenario. For tips, even if the adjusted principal goes below the face value, you'll get at least the face value back at maturity. For I bonds, you'll always get your principal back, but if there's deflation, your compound rate will not go below 0%. You could also invest in a TIPS mutual fund. As I mentioned before, they're included in the Target Retirement Fund from Vanguard. If you buy the short-term TIPS from Vanguard directly, the ticker is VTAPX. This has an expense ratio of 0.06%, which is 60 cents per year for every $1,000 invested. There is also an ETF version, VTIP, which is a 0.01% cheaper, or 10 cents per year cheaper for every 1,000 invested. These fees could really add up, especially if you're talking $1 million or more. You could create a bond ladder for free using Treasury Direct. A bond ladder is just where you buy bonds that mature every so often. For instance, you could start a 3-year bond ladder by buying a $100,000 bond that matures in 1 year, a $100,000 bond that matures in 2 years, and a $100,000 bond that matures in 3 years. Then each year, as a bond matures, you take that and reinvest it in a new 3-year bond. They just kind of cycle through. That way you have a steady stream of interest payments and you're renewing bonds constantly at the latest fixed interest rate. You could create whatever ladder fits your needs, whether it be a 5-year ladder, a 10-year ladder, even a 3-year ladder of bonds that mature every month. This is free to do with Treasury Direct, but it may be worth paying Vanguard to do the work for you. This is effectively what they do with hundreds of bonds instead of just a few. Thanks for watching, everyone. I hope this video was valuable for you. Do you think inflation-protected bonds are good for you? Let us know in the comments below. Don't forget to smash the like button and then subscribe. Later.